If you are interested in investing in the stock market, you may have heard of the terms bulls and bears. But what do they mean and how do they affect your investments? In this video, I'm going to explain to you the meaning and origin of these terms, the characteristics and effects of bull and bear markets, and some strategies to deal with market volatility. Whether you are a beginner or an experienced investor, this video will help you understand the dynamics of the market and make better investment decisions. So, stay tuned and let's get started. Before we continue, I want to remind you that this video is for educational and entertainment purposes only. It is not financial advice and you should always do your own research before making any investment decisions. Investing involves risk and you may lose money. Please consult a professional financial advisor if you need any guidance. Bulls and bears are terms that describe the general mood or sentiment of the market or an individual asset. They also refer to the people who buy or sell securities based on their expectations of future price movements. A bull market is a market that is rising or expected to rise. A bull is someone who buys securities or commodities in anticipation of higher prices, or someone whose actions make such prices go up. A bullish investor is optimistic about the market or an asset and believes that it will increase in value. A bear market is a market that is falling or expected to fall. A bear is someone who sells securities or commodities in anticipation of lower prices, or someone whose actions make such prices go down. A bearish investor is pessimistic about the market or an asset and believes that it will decrease in value. The origin of these terms is not very clear, but one popular explanation is that they come from the way these animals attack their opponents. A bull thrusts its horns up into the air, while a bear swipes its paws down. These actions were then metaphorically applied to the movement of the market. Another possible source is an old proverb that warns against selling the bear's skin before catching the bear. This means that one should not be too confident about making a profit from something that is not yet certain. In the 18th century, some speculators would sell stocks that they did not own, hoping to buy them back later at a lower price. This practice was called selling the bear, or short selling. Bull and bear markets are usually measured by changes in the prices of a broad index of stocks, such as the S&P 500 in the US or the FTSE 100 in the UK. A common rule of thumb is that a market is considered bullish if it has risen by 20% or more from a recent low, and bearish if it has fallen by 20% or more from a recent high. However, these definitions are not absolute, and there may be different opinions on when a market has entered a bull or bear phase. Some factors that may influence the perception of the market include the duration, magnitude, and frequency of price changes, as well as the economic and political conditions that affect investor confidence. Bull and bear markets can have significant effects on your investments. Generally speaking, a bull market is favorable for investors who want to buy and hold stocks for long-term growth. A bear market is unfavorable for investors who want to sell stocks for short-term gains. However, there are also opportunities and risks in both types of markets. For example, in a bull market, you may benefit from buying undervalued stocks that have strong fundamentals and growth potential. You may also profit from selling overvalued stocks that have weak fundamentals and growth prospects. In a bear market, you may benefit from selling stocks that are likely to decline further in value and incur losses. You may also profit from buying stocks that are oversold and have strong fundamentals and growth potential. Of course, these strategies are not foolproof, and they require careful research and analysis of the market and individual stocks. You also need to consider your risk tolerance, time horizon, and investment goals before making any decisions. One way to reduce your exposure to market fluctuations is to diversify your portfolio across different asset classes, sectors, industries, geographies, and styles. This way, you can balance your risk and return potential and avoid putting all your eggs in one basket. Another way to cope with market volatility is to adopt a long-term perspective and focus on your financial objectives rather than short-term price movements. Remember that markets tend to rise over time despite periodic downturns, and that investing is a marathon rather than a sprint. As we are nearing the end of this video, I want to thank you for watching and sticking with me until now. I hope you learned something new about bulls and bears in the stock market and how they affect your investments. If you have any questions or feedback, please leave them in the comments below and I will try to answer them as soon as possible. Also, please share this video with your friends and family who might be interested in learning about investing and finance. And don't forget to like, comment, subscribe, and turn on the notification bell if you haven't already. Thank you for your support and see you next time.